What does Munro Partners mean when we say that we have a capital preservation mindset?
When we talk about our capital preservation mindset, what we're actually talking about is our absolute return funds here. And so on this slide, it shows a good distinction of what we're trying to do here. And so in the bit in white is the stuff that we do and what every other fund manager in the world does, which we have an investment team that follows an investment process, does active research, and it picks stocks. It picks stocks with high conviction. We happen to be a growth equity manager. Lots of people are value managers, some people are bond managers, etc. In our absolute return funds, we also have these things in yellow, and we call these our capital preservation tools. And so firstly and foremostly, we're able to own more cash. The fund can hold up to 100% cash. You'd be surprised, but most mutual funds have to be fully invested at all times. The second thing we can do is we could short sell. So we could short sell certain stocks, or we could also say short sell futures. So we could short sell NASDAQ futures to overlay the portfolio. The third thing we can do is buy a put option. Put options are very useful for downside protection on markets. And the last thing we can do is we can manage the currency, increase US dollar exposure. And all of those tools are designed to really focus on that capital preservation mindset, to give people what we think is an absolute return, not a relative return. And so to summarize that, we say we're targeting superior risk-adjusted returns through the cycle. To simplify that, what we're actually trying to do is do double-digit returns on a 3 to 5 year view. And so importantly, these products, we're not actually trying to beat the market. We're trying to create sustainable absolute returns through the cycle, and we use these tools to actually to reduce the downside through times of volatility. And what we ultimately think in the end, that this will beat the market if you look at it over a 3 to 5 year view.
Can you have a capital preservation mindset in a long-only product?
Yeah, so in the long-only products, so then you're back to talking about the stuff in the white. And in the white, the fifth and most important capital preservation tool outside of the other ones that we have in yellow is the stocks we pick. And so when every stock we pick, we look very hard at, we're looking for strong structural earnings growth through the cycle. We look for balance sheet integrity, and we look for companies that can adapt to deal with any scenario. And we saw that very much through the COVID period last year. With the quality of the companies that we put in the portfolio. And so that number 5, the companies you pick, is definitely obviously very important. The key difference between the long only and the long short portfolio is the volatility will obviously be higher. In both scenarios, we need the companies we pick to do well, but the long only product doesn't have the tools in yellow that can obviously smooth the volatility or smooth the ride for clients through the journey. And so it is a more volatile product.
What are the preferred tools during these bouts of volatile markets?
When we think about the COVID period for us as one period, but we could talk about lots of other periods as well, we're usually running some form of put options in the fund at the time. And for the COVID period, we did have put options in place because COVID was around, right? People knew it was around, but people didn't think it was a problem. And that's a perfect scenario to buy a put option. It's a very left tail risk event. We can just buy a put option over the portfolio. Lots of other fund managers can't. So first and foremost, that was the most useful thing we had. And those put options, obviously, as the market fell, exploded in value and created large synthetic short positions for the fund. Second thing we can do is we can short futures, which is what we did. As COVID got into Italy and as it became clear that it was going to go around the world, the very fast way to hedge our fund would be to short futures on either the S&P or the NASDAQ, and we did that as well. And then the third thing we could do is raise cash. And so ultimately, as COVID became bigger over time, a number of our stocks didn't look like they were going to have a good period, Airbus, for instance, or some of our luxury goods companies. And so we stop lost or we sold those companies, and we weren't forced to reinvest that money because we're allowed to have more than 5% cash in our fund. And so we ultimately raised cash as well. And so those are a good idea of the 3 orders of how the tools could be worked.